NIO stock closed Wednesday session down 26 cents at $6.32 per share. That's about a 4% loss on the day, giving back much of the modest gains we saw earlier in the week. At first glance, it may look disappointing, especially after such strong August delivery numbers and the fresh earnings report. But when you peel back the layers, the sell-off is less about one negative headline and more about a combination of broader market weakness, profit-taking after a big rally, and ongoing caution around China's economy and the EV sector as a whole. Let's walk through what happened today and what it means for the road ahead. First, the market context. US equities were under pressure all day Wednesday. The Dow Jones fell more than 500 points, the S&P 500 slid, and tech names in particular were weak. This wasn't about NIO specifically, it was about investors moving away from risk assets amid renewed concerns about tariffs, inflation, and central bank policy. In that kind of environment, US-listed Chinese names like NIO tend to get hit disproportionately hard. They're seen as higher-risk plays, so when traders get defensive, they're often among the first to be sold. Second, profit-taking. Let's not forget that NIO has had a strong run in recent weeks. From the end of August through early September, the stock climbed more than 30% off its lows, fueled by delivery strength and narrowing losses in its Q2 report. That kind of rapid rebound almost always invites some selling pressure as early buyers lock in profits. Today's pullback looks very much like that kind of behavior, investors taking gains off the table after a hot streak. Third, the China and macro narrative. Investors remain cautious about the Chinese economy. Growth has been sluggish, consumer demand has softened, and concerns about property sector instability linger. Bridgewater Associates, the world's largest hedge fund, recently disclosed it had cut its holdings in NIO and other Chinese stocks, citing macro headwinds. When big names pull back exposure, it reverberates across the market. Add in regulatory overhangs, US-China tensions, potential listing rules, and sector-specific policy shifts, and you get another reason why sentiment can turn quickly. And finally, competition. August was a good month for NIO with 31,305 deliveries, up 55% year-over-year. But rivals XPeng, BYD, and Xiaomi all made headlines too. XPeng reported a staggering 169% jump in August deliveries. BYD sold nearly 200,000 battery EVs in the same period, dwarfing NIO's totals. Even Xiaomi, a newcomer, has begun to gain traction in China's EV scene. For investors, that means even good results from NIO get weighed against stronger momentum from rivals. The sell-off today is partly a reflection of that, money rotating into faster-growing peers or simply out of the sector altogether. So, putting it together, today's 4% decline wasn't about NIO stumbling, it was about the market taking a breather, traders cashing out profits, and continued nervousness around China and competition. Now, let's look at where this leaves us. Technically, $6 remains the critical support level. NIO closed at $6.32, so that floor is still intact. For the past 2 weeks, the stock has consistently defended that line, even amid volatility. The next level to watch remains $7 as resistance. If NIO can hold above 6 and build momentum, the setup for another push higher remains on the table. From a fundamentals perspective, the story hasn't changed. Earnings showed progress, narrower than expected losses, steady margin improvement, and a forecast for 89,000 deliveries in Q3, potentially a record quarter. The August delivery numbers confirm that demand is rebounding, especially for the redesigned ES8 and the Onvo L90 mass-market SUV. The battery swap network continues to expand, with signs of break-even performance in key markets. And Firefly, NIO's small EV brand targeting Europe, Asia, and Latin America, is still slated for 2025. What today's action shows is that progress doesn't happen in a straight line. Even with strong operational results, stocks consolidate, retrace, and test investors' conviction. That's what Wednesday's trade was all about, a test of whether NIO's new $6 base can hold under pressure. So far, it has. Looking ahead, there are a few things to keep an eye on. First, watch how NIO trades in Hong Kong and Singapore. Those listings often give early hints of sentiment before US markets open. If we see stability overseas, it could set up a rebound in New York. Second, keep an eye on macro news. Any updates from the Federal Reserve, new inflation data, or tariff developments could swing sentiment across the board. Third, monitor the competitive landscape. As XPeng, BYD, and others release new delivery numbers or product announcements, investors will be comparing NIO directly against them. So, what's the takeaway from today's 4% drop? It's not that NIO has lost its momentum or that something fundamentally broke in the story. It's that markets are volatile, profit-taking happens, and Chinese EV names are especially sensitive to macro jitters. The encouraging sign is that even after today's pullback, NIO is still above $6, a level it hadn't consistently held in more than 6 months until now. That resilience shouldn't be overlooked. For long-term investors, the focus remains on execution. Can NIO hit that ambitious Q3 delivery target? Can the Onvo L90 ramp successfully? Will the Firefly brand position the company for global growth in 2025? And can the battery swap network move from cost center to profit contributor? Those are the questions that will ultimately determine NIO's trajectory. For traders, the key levels are clearer. $6 is your line in the sand. $7 is the next upside test. How NIO behaves between those levels in the coming sessions will tell us a lot about near-term sentiment. To close, today's sell-off may feel discouraging, but in reality, it's part of a larger story. Stocks don't move in straight lines. After a strong rally, a 4% pullback is healthy, even expected. The fact that NIO is still above 6 and showing resilience amid market weakness is a sign of strength, not weakness. As long as the fundamentals continue to improve and deliveries keep growing, the long-term story remains intact. So while Wednesday's trade was a setback on the chart, it's not the end of the rally. It's a pause, a consolidation, and potentially the setup for the next move higher, if NIO can keep proving itself in the quarters ahead.